Stop what you're doing. If you own or are even just researching AI-adjacent tech stocks, you absolutely need to see this explainer. Last week, I ran Amtech Systems through 5 different financial models, dug into their SEC filings, and checked them against 2 legendary valuation checklists. I was looking for a pattern, an explanation for what was going on under the hood. And honestly, what I found completely shocked me. We are diving deep into the central mystery of the Amtech AI Paradox. It's like a giant puzzle where the pieces just don't seem to fit together at first glance.
Negative 15.61%. That is a massive, incredibly surprising number. It was the sudden, brutal drop Amtech experienced recently. Look, I know the absolute dread of watching a stock in your portfolio bleed out while the rest of the market just seems to be soaring, especially right now smack in the middle of the biggest artificial intelligence bull run in history. It feels awful, right? You start questioning your own research. So what does this all mean for your portfolio? Stick with me, because I am going to give you a clear, actionable framework to look at this company. By the end of this explainer, you'll know exactly if this 15% haircut makes Amtech a brilliant Warren Buffett-style buy-the-dip opportunity or just a classic Peter Lynch value trap.
All right, Section 1, the AI stock paradox. We really need to unpack a flurry of seemingly contradictory news, positive catalysts, and harsh market corrections surrounding this company right now.
Moving to Section 2, what Amtech actually does. Let's look past all the flashy buzzwords for a second and examine their core business model.
Okay, to really understand their market position, think back to the gold rush. The people who made the most reliable money, they weren't always the ones out there mining for gold. They were the ones selling the picks and shovels. Amtech is exactly that. They don't design the flashy AI chips that make all the headlines. Instead, they provide the absolutely critical semiconductor packaging and advanced wafer substrate fabrication equipment required to physically build those AI GPUs and advanced electronics. Essentially, they sell the heavy machinery and the consumables that the entire semiconductor industry relies on to manufacture components, like silicon carbide power devices.
And you know, Amtech is actually an umbrella for some really heavily established names. We aren't talking about some scrappy pre-IPO startup just hoping to find their footing here. No way. They operate premier brands with over 40 years, 4 decades, of battle-tested experience in the semiconductor business. We're talking names like BTU International and PR Hoffman. These are deeply established entities with real roots in thermal processing and fabrication solutions.
Just look at this breakdown. Their global reach is undeniably massive. A staggering 55% of the revenue comes straight from Asia, which is the undisputed epicenter of global semiconductor manufacturing right now. The Americas make up 30%, and Europe sits at 15%. So, think about it. When global chip manufacturers are desperately ramping up production to meet this insatiable demand for AI data centers and advanced automotive electronics, Amtech's global infrastructure is sitting right in the crosshairs of all that demand.
Section 3, financial turnaround and backlog. Let's crack open that Q2 2026 earnings report and see what the numbers actually say.
Wow, the contrast here is just stark. For the 6 months ended March 31st, 2025, Amtech posted a massive net loss of $31.5 million. I mean, that's the kind of number that literally terrifies investors. But fast forward exactly 1 year, and they have completely reversed that trend. They posted a positive net income of $1.27 million. They successfully stopped the bleeding and steered the entire ship back into profitability. That is no small feat.
And it's not just some one-off accounting trick either. The underlying demand is absolutely there. For the latest quarter, they reported $21.1 million in new customer orders. This figure clearly demonstrates a really strong, ongoing demand for their thermal processing and fabrication solutions from those massive global partners we just talked about. Furthermore, their current backlog sits at $22.3 million. Now, in the manufacturing world, a backlog is essentially guaranteed future revenue. It just means customers have already placed orders that Amtech simply hasn't fulfilled and billed for quite yet. Having this gives the company a really solid runway of visibility right into their near-term financial future. Which brings us to Section 4, the $60 million dilution. Let's see how they're actually capitalizing on this major turnaround.
So here's the $60 million question. If the financials are turning around and they have this massive backlog, why on earth did the stock plummet?
Well, the answer lies in their recent $60 million public stock offering. Reading directly from their press release, management stated the net proceeds will be used to accelerate growth across its semiconductor packaging and advanced wafer substrate fabrication platforms, accretive merger and acquisition opportunities, working capital, and general corporate purposes. Impartially speaking here, this is a highly aggressive growth strategy. Management believes that right now is the absolute best time to acquire competitors and expand, and they need a $60 million war chest to make it happen.
This really reveals the dual-edged sword of public offerings. On one hand, the company gets a massive cash injection to expand their footprint and potentially totally dominate their niche. But on the other hand, existing shares get diluted. By issuing nearly 3 million brand new shares out into the open market, the piece of the pie owned by current retail investors suddenly gets a lot smaller. Historically, as you might guess, this almost always triggers a short-term sell-off, because the market rapidly reprices the stock based on that new, higher share count. They priced those nearly 3 million new shares at $20.50 each. But here is the truly fascinating twist that a lot of retail investors completely missed while they were panic selling. The offering was actually oversubscribed. That is a massive detail. It means that institutional investors, the big players with the deep pockets, actually wanted to buy more shares at $20.50 than Ameritech was even willing to sell them. It shows a remarkably high level of institutional confidence in the company's long-term M&A strategy, which entirely contrasts the retail market's fear-based sell-off.
Okay, let's wrap this up with Section 5, Outlook for 2026. Let's take a look at the road ahead.
Breaking down their latest guidance, they project revenues between $19 and $21 million for the upcoming quarter, showing some really steady, consistent demand. They also expect their adjusted EBITDA margins to sit comfortably right in the high single digits, which proves they can actually maintain profitability on those revenues. But most importantly, they have a net operating loss, or NOL, valued at a whopping $74.3 million. That is essentially a massive tax shield. As Amtech generates profits moving forward, they can use this historical loss to offset their tax burden. That means a whole lot more of their earnings will drop straight to the bottom line.
So we've seen the 15% drop. We've seen the impressive return to profitability, and we understand the mechanics of the dilution versus that oversubscribed institutional demand. It leaves us with this final, incredibly provocative question. Will Amtech's $60 million bet actually pay off? As an observer, you really have to weigh the undeniable short-term pain of share dilution against the long-term potential of a fully funded, aggressive M&A expansion strategy right in the heart of the AI semiconductor supply chain. So, what do you think? Is this the ultimate value trap or the perfect dip? Thank you so much for joining me on this explainer, and keep exploring the numbers.